The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Inflation angst bumps up against AI optimism for, yet another day. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
Are you the angst? Am I the AI optimism?
I'm
Caroline Hyde. We're kicking off the closing bell here in the US. Let's check out on what's happening in these markets because, look, there is a bit of angst under the hood, Romaine. We're seeing S&P 500 off by 0.5%. Look, we're on the downward stretch as we think about geopolitics, we think about oil inflationary pressures. But the semiconductors, what a volatile day. We're actually higher by 0.5%. In the beginning of trade, we're off by more than 2%. Volatility, the watchword, 3-year yields at highest that we haven't seen in decades. And we move on to what Brent crude is up another 0.4%. I know you're looking at that inflationary pressure.
Absolutely. Here we talk about that point jump, I should say, in the 30-year Treasury yield since those bonds began falling over Tehran just 3.5 months ago. And that stirred up, Caroline, a big structural cross-asset market problem rather than a temporary one. And I'm going to oversimplify this just a bit, but it all comes down to the cost of money itself for bond investors, stock traders, corporate borrowers, and consumers. And that is undeniably the big risk should interest rates remain higher for longer. Now, we're already seeing that play out with a few other consumer names. Home Depot missed sales estimates amid a pullback in upgrade projects. Pet supply retailer Chewy said it's seen more evidence of a stretched consumer. Sentiment supported by Bloomberg's second measure transaction data that shows households continuing to spend, that's good, but putting more of that spend through revolving credit rather than cash. Another read on the consumer is up ahead with earnings from Kava tonight and TJX and Target in the morning. The cost of money, also a concern for the AI boom, and chip maker NVIDIA. It reports earnings tomorrow afternoon. The always opinionated Michael Burry in his latest Substack post arguing that the AI build-out is a dead ringer for the dot-com bubble. He cites how AI is absorbing huge amounts of early-stage capital and debt issuance. He questions whether enterprise demand will actually surge as the bulls have forecast, and he claims consumers have shown no willingness to be significant sources of revenue for AI projects.
Is that what we call lower value human capital, Romaine?
Ooh, wow.
That was a brutal
That's a trigger
statement.
word there.
This is what was coming out, of course, of the CEO of Standard Chartered as they talk about the redeployment of really their resources away from human capital and into AI capital. But AI capital is where I look. This is what's been supporting the stocks on the day. This is where we're seeing the hope and the prayer around NVIDIA, the world's most valuable company, more than $5 trillion worth, but still a $5 trillion juggernaut can put up revenue growth of 79%. We almost become numb to it, Romaine, but these numbers are still phenomenal. We're hearing from that report yesterday, that incredible interview by Ed Ludlow with CEO Jensen Huang. He was still sounding pretty darn bullish.
Absolutely here. And actually, I'm going to make a presumption here, but I think our next guest is somewhat bullish on the space as well. Ankur Crawford joins us, Executive Vice President and Portfolio Manager over at Alger and NVIDIA, one of her largest holdings and a couple of the funds that she manages. Do we need to focus so much on EPS and revenue? We know the numbers are going to be phenomenal by any stretch of the imagination. Or are you more sort of interested in that, transition from Blackwell to the next big thing?
Yeah, I think what is the biggest concern right now is demand. And Sundar Pichai, Google, they're hosting Google I/O. Mm-hmm. I think it's still going on right now. Yep. What did he say? He said internally their token usage is doubling every 2 weeks. I think it was a 500x growth in token growth over the last 2 years. So demand for intelligence and for tokens is up and to the right. And over the last, I would say, 4 to 5 months, it has only accelerated. Mm-hmm. So really, that is the key for NVIDIA. As long as the demand is so strong, you'll need the chips that, create or satisfy that demand. Mm-hmm. So I don't know. Does it matter what they do tomorrow? I don't know. Be it beat and raise, great. 2 billion more. Then we have the Rubin.
Yeah, and then the Rubin, then whatever comes after that, the Hoagie. I am curious, though. I do want to pick your brain. Because before you, I know scientific terms here, but you're basically a scientist yourself. Before you got into investing, you worked at Intel. You have a background in engineering. I am curious when you hear this talk about maybe having less of a need for those high-end Blackwell chips, and the idea that we're moving to this inference phase that maybe can be supported by somewhat lower powered chips. Does that threaten NVIDIA, or is that going to be complementary to it?
No. So first of all, I think there's a little bit of a misnomer and understanding of you're always going to want to try and be at the frontier, and in part because you can do more with less. So if you have 10x the performance with the same amount of compute costs, why would you not use that? That is the most efficient way to get your intelligence out. So, so that idea of like not wanting to use the highest end chip, I think is a little bit of a misunderstanding, because you're always going to want to do it in the most efficient way. There's no reason for you to go use an older chip. Now, if it's there and fully depreciated, you'll use it, but it'll be slower and it'll use more electricity. And we know that electricity is scarce today. So, I don't understand that argument, to be honest, because it just doesn't logically compute.
Ankur, what's interesting, of course, is what you then go and do with all of this compute. And it's the AI models we're seeing being built. Just think about the fear that has become wide-sweeping, particularly in Wall Street, about Mythos, and that's the Anthropic latest model that's so sophisticated and powerful it can't be let into the broader hands of us mere mortals. Wall Street, we understand the watchdogs are actually pausing some cyber exams remain after the Mythos shock, so people still trying to grapple with how they stress test Wall Street's overall systems in the light of these ever more powerful models. But Ankur, I think about the news that we got today with Blackstone, putting in $5 billion of equity to get into bed with Google as they have their I.O. event on. We also know them for Google Cloud. But they're thinking putting TPUs into other data centers to take on the other neo-cloud providers, such as CoreWeave and the like. What does that mean for NVIDIA? That TPUs and other ASICs are just getting ever more sophisticated?
So one of the things we have to start thinking of is, just because there's TPUs going in the ground does not mean that the TAM is shrinking. This is it's a growing pie right now.
All these agents.
We are not fighting for share today. So if we come at this from a more abundant mindset,
yes,
we're not concerned about who is taking share from who, because the pie is massive and it is growing. So, TPUs should go into the ground because there are going to be some workloads that TPUs are really good for. Right? If there is a consistent workload, you want to use a TPU. If there is a broader based workload, you might want to use a GPU. So there's going to be like niche end markets and workloads that will run across every single kind of GPU, XPU, TPU. And is it a risk to NVIDIA?
Dare I throw that one in? What's interesting, though, is what we've seen a bit of a rotation in earlier in the play today was out of hardware, which has ramped up. I mean, the stocks is up at 1.70% since the end of March, and it was starting to tentatively go into software. Look, we got Intuit after the bell tomorrow. I mean, it's going to be very much second fiddle to the enormity of the macro event that is NVIDIA. But how have you been thinking about the software disruption and whether or not we're starting to see the opportunity to catch a falling knife?
Yeah, well, a falling knife it is. And so you generally don't want to catch one, but there is some opportunity and it is tempting sometimes. But remember, these are trades and not investments. Because which of these can really cross the chasm in the AI world? Which of these actually has a better outlook competitively in 3 years and 5 years than they have now? And that's what you have to differentiate in the software world. And if you can identify that, those are the ones to own. But the rest of them, I think, are challenged. And one of the biggest places I think they're challenged is on their margins. Because at minimum, they'll have to, or they won't be able to take pricing like they've been able to take pricing.
Look, companies aren't vibe coding a Intuit or a ServiceNow, but they have got the ability to perhaps say, well, I might not pay so much for my services.
And you know what? They can vibe code it, right? So on average for enterprise software, we use probably 15 to 20% of the software package, and in part because they're generalized software packages that companies use. So why do you need the other 80%? Why can't you just build yourself something that's relatively, more catered to what you're doing? You can.
Yeah. I do want to get your thoughts before we let you go, just about the broader ecosystem, the broader flywheel of what AI is maybe bringing to markets, and kind of overlay that with some of the recent concerns about the rise in treasury yields, interest rates, the cost of money, and whether that is any sort of impediment to the continuation of these growth rates.
So, what I would say is that at 6%, kind of rates that a lot of these companies are getting. I think Nebius just did a deal, or I forget, a few of them just did a deal. And, the interest rates that they're paying on their debt, because they're converts, they're very creative structures. They're 1% and 2%. So there are ways to get around kind of the interest rate using converts. But I will also say that that cost of interest that you're paying relative to the amount of ROI that it will add is relatively low. And so will it stop this build out from happening? Absolutely not. I do think that, you know, there's other concerns, like we have to make sure that there's enough electricity and connected electricity, and that doesn't stop the build from happening. But I don't think it's going to be interest rates.
All right, Ankur, got to leave it there. Always insightful, great insights out of Ankur Crawford, Executive Vice President and Portfolio Manager over at Alger. Meanwhile, we have some breaking news on the Las Vegas Raiders football team here in the U.S. We knew it was up for sale, and now we're getting a report here about who the new owners might be. It's a collection of folks: Ari Emanuel, Mark Shapiro, Michael Dell, Joe Barata, and Egon Durban, all combining here to raise, either increase or take new stakes in the Los Angeles Raiders. Remember, the last valuation round for this team put it at roughly around $9 to $10 billion. We'll see what these new investments take it as well.
Mark Davis will continue to be a controlling shareholder, we understand, according to Variety. But it's interesting that a lot of people are putting money to work in AI, or indeed the opposite of AI. Ari Emanuel is the anti-AI bet. He's all about people coming together in real life, Romain.
Yeah.
Watch real sports.
Well, it's good to see Michael Dell putting some of that server money to use. We'll be back in a moment. This is Bloomberg.
Inflation concerns. They are growing, more pronounced in the US bond market at least, pushing the yield of the 30-year Treasury to its highest level since 2007. Our next guest just lifted his second quarter GDP estimate, though, on solid economic data. But says the downside risks remain for the latter half of the year. Joining us now, Mike Feroli, Chief US Economist at JP Morgan. What's the driving force for your, dare I say, a little bit of optimism on GDP?
Well, just the data that we've been getting. So we had retail sales last week, which came in stronger than expected. You know, things like jobless claims continue to also signal the labor market's holding in. So we're not really seeing much of the damage yet from the higher energy prices, which we had been expecting. But, you know, maybe we'll see that in the future. But certainly the data we have in hand suggests this economy is remaining pretty resilient. Let's
go to the jobs in the second half, or even further out than that, because the most read story on the Bloomberg when I came in this morning, it was all about Standard Chartered being the latest to articulate what AI is doing to their workforce, a reallocation of capital, less towards rather painfully suggested lower value human capital, but more into, well, investing other capital into AI. But is that going to become more of a forcing function?
Well, finance is a very small part of the U.S. economy, right? A lot of the job growth we've been seeing has been in things like healthcare, which are harder to, at least in the near term, harder to replace with AI. So I would expect it's those kind of jobs, blue-collar jobs, healthcare, hospitality, that will probably see much of the remaining job growth this year.
Since Caroline didn't ask you the hard-hitting follow-up question, I'm going to go back there to your GDP forecast. I understand the idea of maybe not lowering it, but what type of visibility, or what type of confidence, I should say, do you have that the ripple effects from the war in Iran won't actually ding economic activity?
So this is just for the second quarter, right? And so the second quarter, we're already getting a fair amount of data already. Further out, we do expect that there will be an effect, right? We expect that saving rates will go back up, and that will weigh on consumer spending in the second half of the year, which should slow things a little bit. But we're not, as I said, we're still seeing a lot of resilience in business behavior and hiring. So I think even with somewhat slower growth, the economy still looks pretty good.
When it comes to the closure of the Strait of Hormuz and the impact that's having on the energy market, is there sort of a line in the sand you look at in terms of the duration of this closure where you do start to get a little bit more worried?
No, we don't really see a lot of nonlinear effects. With each passing day and each increase in energy prices, that's a further headwind to consumer spending. But I don't think there's some magical level like $5 a gallon or $6 a gallon that's going to break, per se.
Does it matter the K-shaped nature? And whether we're likely to see, of course, oil pricing pressure on energy affect one part of the economy more than others, and what sort of economic damage that has in terms of ripple effects?
Yeah, so there is a concern here that the lower income consumer, who spends more on energy prices, is the one that should bear more of the brunt. Also probably received less of the benefit earlier this year from higher refunds. Right, so I do think if we move on each passing day, each increase in energy prices, where we would expect to see the weakness is in the lower end, which actually has been holding in so far fairly well, but that is, I think, the area of vulnerability here.
I do want to go back to the AI question, not so much from the negative impact on the labor market, but the potential upswing in productivity. Actually, one of your colleagues in one of your other departments at JP Morgan is just out at a conference in Boston, and she was talking about internally the productivity gains that they've seen at JP Morgan, but more importantly, what she expects to see across the corporate landscape. Is that something that's quantifiable yet?
No, it's very speculative at this point. And estimates from academics are pretty much all over the map. So this is not only a forecast about the future, a forecast about productivity is going to be particularly hard. I would say that so far the productivity gains we've seen in this expansion, which have been better than the last expansion, we don't think a lot of that is due to AI yet. It seems like there was a lot of churn, reallocation that probably helped productivity. That may be behind us, so I think going forward it will have to be this dividend from AI that most people are expecting.
Is the dividend from AI at the moment the vast amounts of money that capital expenditure is coming from a very few key players?
Yes, that's right. So first quarter, we saw that AI-related or tech-related CapEx contributed almost a percentage point to GDP growth. Now, a lot of those dollars are going into imports, so they're actually not adding a ton of jobs in the U.S. We think data center construction jobs might be somewhere around 250,000, which is not nothing, but in the grand scheme of the economy, it's not a massive number, particularly when you think about those dollars that people are citing. So a lot of that is actually going into Taiwanese and Korean GDP, right?
All right. Mike, always great to have you.
Good to see you.
Great insights. Michael Feroli there, Chief U.S. Economist over at J.P. Morgan. When we come back, we're going to continue to talk about the economy and a critical litmus test for consumer behavior. With consumer behavior, sentiment, I should say, sitting at a record low. We're going to preview this week's retailer earnings report. Simeon and Siegel over at Guggenheim joining us next, right here on The Close on Bloomberg. It's a big week for retailers. TJX, VF Corp, Ross Stores, and quite a few others set to report earnings this week. A keen eye, though, on TJX and Ross, which could prove to be a key litmus test for how discount shoppers are dealing with some of the economic pressures out there. Simeon Siegel joins us right now, Senior Managing Director and Senior Analyst of Retail and E-commerce over at Guggenheim Partners. All right, we were just talking with Michael Feroli, a Chief Economist over at J.P. Morgan. He seems to think, at least in the shorter term, things are okay with the economy. People will continue to spend. But I am curious. We've seen some of the earnings reports from the last go-round, and it seemed to suggest that there was a little bit of stress, particularly along middle-income and lower-income consumers.
So first off, good to be back.
Absolutely.
Good to see you guys. I was watching you get through that whole name was like a big mouthful, like Simeon Siegel at Guggenheim Partners, a lot of vowels there, so like appreciated that.
I practice.
But I think that, and I was watching the Michael bit, and I agree with him. I think we have this view that the K-shaped economy is taking over everything. And it's very easy to jump on board, and I don't mean to belittle it. Obviously, high income and low income deal with higher gas prices in a very different way. But to your point about TJ and Ross, we're going to see really strong sales out of these businesses.
Yeah.
But the interesting thing is, you brought up, the middle of the earnings right now.
Yeah.
Last week was a very strong earnings week too. Stocks didn't reflect it.
Yeah.
Revenues did. And so what we're seeing revenues grow really across the board, like accelerating to high single-digit range for retail, and that's both high income and low income.
Well, I am curious, particularly with some of those discount retailers. I mean, hasn't some of their growth of late been because of those higher income consumers coming down and rummaging? I mean, I never understood TJ Maxx, but you just rummage around for stuff? Is that
you
how
never
it works?
understood TJ Maxx yet. Growth mindset, okay? It's a fantastic... TJ doesn't sell cheap clothing. They sell expensive clothing cheap. They're just waiting for you to find it.
This is exactly what my mom tells me every
right?
night. She goes to TJ Maxx like 3 times.
But you're like a rummager of records.
Yeah,
so it's like the same mentality, but in
the
clothes.
smartest and most powerful thing TJX did was they created this idea of a treasure hunt.
Yeah.
So they've convinced the world you can go and hunt treasure, and it's really fun.
Yeah.
I don't know there's a pirate in history that enjoyed hunting treasure. You like finding and walking away with the treasure. They've gotten us to think, oh, it's fun to rummage.
Yeah.
And so like this word rummage, they can use it just as well, but that's what they've gotten you to do. You go and you think, I'm gonna put in the time and I'm gonna walk out with the hottest Nike. Or I'm gonna walk out with something that I could get full price somewhere else, but I'm gonna get it a really good deal. And what's also really special is they've convinced you that it's not embarrassing, it's a badge of honor.
Yeah.
Value became a badge of honor. But to your point, right, I digressed. Yeah, in theory, they're going to benefit from trade down, and they certainly have, but they are also benefiting from their core customer. What makes TJX and Ross stores so special is that they grow with traffic. All of my retailers right now are seeing price. Tariff, whether we would have thought or not, tariff raised the price for the U.S. consumer. The U.S. consumer is absorbing that price. They're sharing it with the companies, because I told you revenues are accelerating, gross margins not. So companies get the higher price, but they also absorb it on the cost side. So we're sharing it, but you're paying up. TJ and Ross are not just seeing higher prices, they're seeing more units, which means people are walking in those doors from both sides of the equation.
I was with the VF CEO last week, and it's interesting how they're still making space for innovation actually, as well, bringing limited editions, trying to think about how you personalize, how you're trying to get people excited for brands that maybe they put down a little bit, but actually Vans are coming back across sort of different age groups and demographics. How are you seeing companies that have a myriad of different types of brands on their hands lean into this moment?
Isn't Bracken great?
Yeah.
He brings a totally different perspective to this. It's someone who focuses on gross margin.
He was Logitech CEO. He used to be in tech.
And that's what he says. He's like, okay, great, the mouse guy is going to come and do clothing, right? So, but he has this view of brand. And I think what makes this special, this is not selling cereal. Selling cereal is a very hard thing to do, but it's a different skill set. This is selling the magic of irrationality. Brand is all about how do you get me to pay more for the same thing? And that's what I think he's focusing on really well. And so what he needs to do is he needs to generate that higher interest in Vans. And this is what, again, Nike's dealing with, Ralph, Coach, the ones who do it well. What's interesting, and this is, I think, going full circle, what we're not seeing is luxury doing really well, discounters do really poorly. What we're seeing is luxury do really well in certain spots. Prada's growing, and then we're seeing luxury challenged in certain areas. Gucci's not. We're seeing big box do really well in certain areas. Walmart's growing, and then Target's not. Coach is doing really well. Michael Kors is not. What we're seeing is market share stories, and that's brand. That's market share. That's what businesses are supposed to look like. Mm-hmm. And that tells you that in each subsector, there's a K-shaped version of businesses that are doing well and not, as opposed to high-end's working, low-income's not.
Okay, so push us forward to therefore how that shows up in metrics. When it's not working, what is the through line? What's the trend? What are they missing?
So if you're not speaking to your customer. And so if what we're finding, counterintuitively or not, with all the negatives macro, we're seeing people still open up their wallet for discretionary spending.
Romain, were you opening up your wallet for the Bitcoin Satoshi Van, which has been flying off the shelves, that is worth thousands of dollars? I thought it spoke to you in particular. It's a Satoshi Nakamoto Vans.
Well, you should know I would never be caught dead in Vans. I would be caught dead in Gucci.
I was going to say it's more of a Swatch AP type of a guy. I saw him outside that store break it.
Well, not for $5,000 or whatever it's going for in the second tier market. Go ahead.
No.
Yeah, but go ahead.
No, you.
You got 30 seconds, man.
That's the point.
Yeah.
The fact that you can take this branding, sell out of it, and then 10 times the price, that's what makes these brands special. Those are the ones doing it right. The ones aren't, they're not speaking to their customer when the customer is willing to spend.
Yeah, interesting. By the way, where's that jacket from? Is that from TJX?
I'm not going to tell you.
Okay.
He rummaged.
Simeon Siegel covers the retail space over at Guggenheim, partner, senior managing director there. As we continue to count you down to the close, we continue to focus on retail, luxury retail, with the CEO of Saks. 3:30 p.m. here in a sweltering New York City. This is the countdown to the close. I'm Romain Bostick.
I'm Caroline Hyde. I'm glad that we matched today, given it's all about retail and fashion.
Absolutely, here. And we were just kind of talking about, I guess, the lower end, at least on the price point, of what's been going on in the retail and fashion sector. Now, I think we want to talk a little bit more about the higher end. And it was kind of interesting. There's been a lot of talk here about some of the luxury brands and whether they're struggling, particularly with some of their markets in China and the Middle East and in Europe. LVMH apparently divesting some of its brands, trying to sort of get a little bit more back on track.
And does that mean, even though we're sweltering in New York, people are still buying all the luxury brands? This is where the growth market is. We've just there's a great piece out in Bloomberg Opinion. Our friend Andrea Felstead, based over in London, talking about how we're seeing a slimming down. She's calling it the great garage sale, the luxury bling garage sale in many ways. Marc Jacobs, that sold on. But how much is that about trying to reorientate yourself towards a growth business in some way?
Well, it's kind of interesting. I had a chance to catch up a little bit earlier with the CEO of Saks Global. Now, they are in bankruptcy. They just recently filed their bankruptcy plan, hoping to emerge in June. And he talked a lot about the longer-term opportunities. And he was very clear that the U.S. market, at least for right now, is where a lot of the growth is. And he still sees sort of a big role for brick and mortar luxury multi-brand retail outlets. The CEO there, Geoffroy van Raemdonck, he caught up with us just a little bit ago. Here's part of our conversation.
We filed for bankruptcy a little bit more than 4 months ago and have made significant progress because we've secured $1.25 billion of liquidity. We've entered in a restructuring support agreement with our lenders to provide $500 million of exit financing. And then we just got court approval for a disclosure statement. So where we are right now is that we are soliciting votes for the plan of restructuration. We have support from the lenders and the unsecured credit committee, which includes many of the luxury brands. And then confirmation is scheduled for early June and emergence late spring, early summer.
And some of the other legal issues that you had faced, including the dispute with Simon Property over some of those broken leases, has that been resolved as well?
conversation with Simon came to fruition in a really positive way. David Simon himself really worked to make sure that the collaboration and the partnership spirit was there. And so we just filed yesterday that all those elements are settled, and we are continuing as great partners in many locations together.
There was a lot of hand-wringing when this bankruptcy was filed. People look at Saks, Neiman Marcus, Bergdorf as kind of being the pillar of a multi-brand luxury retail experience. And I even spoke with some of those brands who were very worried about what the loss of those stores would actually mean for the luxury retail space. Have you given them enough assurances that not only are you going to exit bankruptcy, but that your long-term plan is going to be viable to thrive?
So we've given a lot of assurance to the brands that, as I mentioned, the big groups are part of the Insecure Creditor Committee, and they're supportive of the plan. What the plan shows is that we will exit with about $700 million of available liquidity, that we are going to be profitable this year and grow the business to be a $9 billion GMV business. That is going to be done on a smaller, more productive, and more profitable footprint, and that is going to be more profitable because we'll sell more at full price. We are showing growth that is going to be quality growth, and that growth for us means growth for the industry because we will be buying more from the industry. And ultimately, we have a path to be double-digit EBITDA profitable. And I think that's really important to me. I came back to get this business out of bankruptcy, but to make sure that it is on stable ground and grows profitably, because the role you mentioned is real. We play a very big role in the industry. We buy about $3 billion at cost from the brands. That's revenue that feed their own businesses, and a Saks Global that speaks to the luxury customer that is stable and growing and profitable is a cornerstone of the industry.
I could understand how you can get to double-digit EBITDA. What was it, by fiscal year 2030 was the idea. But then when I looked at some of your revenue growth numbers, I mean, we're talking about a compounded annual growth rate over the next few years of like 5, 6, 7%. Is that really achievable? When I look around the retail landscape right now, it's hard to find companies that have that type of compound growth rate.
So I think you need to put this in the context of where the business is today. The business last year had liquidity problems. Those liquidity problems led to lack of payment to the brands and ultimately lack of inventory. So we entered the holiday season with very low inventory and almost no shipment of inventory in November, December, January, and February. And so the performance of last year and at the beginning of this year is still negative compared to what we did pre-merger. And so we are looking over the next 2 years to go back to what we did pre-merger. And that is really a factor of having the inventory. We see that when we have the inventory, we sell it. It's just a notion that we didn't have the inventory at all times, and we now see the value of it. And then ultimately, it is the strength of the company together that we believe can outpace the industry.
I am curious about your relationship with them. And I mean, your background before you ran Neiman Marcus and now Saks Global. I mean, you were a vendor yourself to a certain extent, or you worked for those vendors. Are you confident you're going to get most of them, if not all of them, back, the ones that you had prior to the bankruptcy and the issues?
I am confident in the sense that today, if I look at the top 200 brands that make the vast majority of our GMV, none of them have left us. Okay. So even today, knowing that we had payment issues last year, knowing that we went through a process, they all stuck with us. And if I look at the brands that are shipping today, we have more than 700 brands that are shipping. And we received in last quarter, which ended at the end of April, $2 billion of inventory, and that is 102% of what we intended to receive. So I think what's interesting here is we play a key role. When we are not well-financed, brands are worried. But as soon as they see the liquidity coming, as soon as they see a plan that focuses on customer, that focuses on profitability and on retail, we had a lot of activities that were not profitable and that were not retail, then they all rally and support. And I was in Europe over the last 2 weeks. All the conversations are about how do we scale growth? Because you need to put this business in the context of the global business. Luxury is being challenged today in many parts of the world, the US is the market that is growing, and we are the gateway to the US customer.
I am curious about the complexion of that market. There's been a lot of talk that, yes, well-to-do people are still buying luxury goods, but they're also doing it in a different way. Some are more cost-conscious to a certain extent, or value-conscious is maybe the way of putting it. Some are also gravitating more to the resale market rather than buying firsthand.
So if you look at the luxury brands and the luxury customers, it's very correlated to the high net worth individuals. We do a survey every quarter that we call our Luxury Pulse survey. It is a database of customers who engage with us. It's statistically significant. And what we saw is we asked them a couple of questions. So we asked them, how do you feel about your personal finances? And 76% of them said, I feel optimistic, and that's 11% up to last October. When we asked them, are you going to buy equal or more in the next 3 months? 57% of them said yes. And the willingness to pay full price is at its all-time high. And so I think from a standpoint of the luxury customer that really participate multiple times in luxury, that segment is very strong. We see that our top customers are up to last year, despite the fact that the company is not up to last year. So I do think that is a very strong segment. Now, I think what customers are a little bit is what you're saying, they're discerning. So they're looking for the brands that offer newness, that offer value for the price, and that offer a brand that has strong congruence with its offering. And when those three characteristics are there, we see that there's no price resistance and there's growth. I think the challenge is when the brand proposition is not as coherent.
And that's Saks Global CEO Geoffroy and Raemdonck, who was brought in when the company filed for bankruptcy. Now, having filed its plan to potentially emerge from bankruptcy, still awaiting on approval from the creditors. A judge has to sign off, but he says he's confident they can get this done maybe by early in the summer. And then he said they'll start thinking about communicating a longer-term strategy for investors.
Does that mean they're coming back to Hudson Yards? Is it going to be back to Neiman Marcus days? We're not going to have to just go to Bergdorf?
I don't know. I mean, he actually said he doesn't even plan to increase their footprint. He said basically they got, something like 40-something stores, and he said at least in the short term, that's pretty much all they're going to have, and they're going to focus on increasing the EBITDA coming out of their stores rather than trying to increase the footprint.
Is that online marketing then, Romain?
I don't know. We'll see. I don't know. Have you
You're an
been,
online shopper guy, I know.
Have you been to the restaurant at the top of Bergdorf? And then
no,
they have one
fancy?
at the top of the... Oh, yeah, it's very fancy. Well, they have, yes, it's very fancy. And they have a nice fancy one at the top of Saks as well. Yeah, so we got to get you back in the city. I know you're like a suburbanite. Where do you live? You live
I know,
like in
I just spent all my time
somewhere.
on Amtrak. That's where I eat my best meals.
Well, at least it's not the LIR. All right, when we come back, we're going to turn back to what's been happening in the tech sector and take a closer look at Cisco. It had been a high flyer, but some comments out of the CFO taking a little bit of wind out of the sails. That's our stock of the hour, and it's up next right here on The Close on Bloomberg.
Stock we're watching, Cisco, our stock of the hour. Shares, they're down about 2%, as you'll see, after the company's CFO warned it would see ups and downs with its gross profit margin, as of course it pushes into AI infrastructure. Bloomberg TV market correspondent Norah Mulinda joins us now to break down what has been a phenomenal run for Cisco with its back of its earnings. I mean, Friday it was up a phenomenal amount, about 17%. Profit taking, or really a bit of a worry about margin here?
So, as you mentioned, this stock has really been on a tear, surging substantially this year alone, but a little bit of a breather that we're seeing today, just down at more than 2%. Investors really clearly trying to figure out which names they want to be in this moment. The stock has had a pretty substantial run, so could be a little bit of profit taking there. But also what investors are really trying to parse through here is whether or not some of these companies are able to kind of push through and actually see returns on everything that they're invested in right now. So in this situation, Cisco, they're trading some margin for market position in the AI arms race. So it's about whether or not these investors are willing to stick around and they believe that they're actually going to be able to see this in hardcore revenue. But it doesn't seem as though that's necessarily a demand issue right now, nor is it a revenue issue right now. Just a little bit of a margin breather, if you will, is what the company's saying.
I am curious, though, too, and I understand, the phenomenal run the stock has been on, but we've kind of heard this concern bubble up with a few other companies as well. This idea that, yes, they're playing in this ecosystem, but at what cost? And is that actually going to translate into increased growth rates, both on the top and bottom line? Is there any sense here that what Cisco articulated today is part of a broader problem, or is this just kind of a one-off?
Well, it's something that we've been hearing from many different companies, and especially as people, investors really on Wall Street are really trying to dig into each individual names. They're trying to see who's going to rise to the top in the end, because everyone's talking about this massive AI build out. We've been talking so much about artificial intelligence, but it's about which of these individual names are actually going to be able to see returns on the long term versus just promises that we're making right now in this moment.
But I mean, you guys interviewed Jensen Huang the other day, and Michael Dell, and Jensen, as always, was very bullish on kind of the growth for, not just for his company, but for the chip industry overall, and obviously whatever the feed through is to the rest of that AI flywheel.
That's where the margins are. Margins are phenomenal. Think about how Samsung's profitability is ramped higher, SK Hynix and Samsung. But over here, NVIDIA, their revenue is going to be 79% increase.
What about here in the US?
NVIDIA's going to see revenue up 79% and EPS about a similar amount. This is just, they're just spitting out cash. It's the software side of the equation that people are worried about.
All right, Cisco down about 2.5%. Norah, Mulinda there with our stock of the hour as we move closer to the closing bells, with stocks remaining on the back foot. Ted Smith, who's going to be joining us in just a second from Union Square Advisors on The Close.
We have the largest supply chain in the world. Our partners have done a great job securing supply for us. And so all of the pieces go together. The silicon photonics is lined up. Everything is all lined up. It's just that the demand is much greater than the overall capacity of the world.
The man himself there, Jensen Huang, speaking yesterday with a Bloomberg Television. I am Romaine Bostic. That's Caroline Hyde. And we are counting you down to the close.
We are. And look, tech at one point earlier when hardware took a hit. We were having anxiety about whether the run-up in hardware and chips had gone too far. But the key litmus test is after the bell tomorrow when we see whether NVIDIA really delivers.
Absolutely. I mean, but you were going through some of those analyst expectations. We're talking, what, 70+% revenue growth, 80+% growth in terms of the earnings as well. For a company that size, that's phenomenal. And we're wringing our hands over that. And I understand you look at the valuations. But, you know, there's an interesting nugget, too, that I was going for.
Yeah.
Did you look at their free cash flow?
Is it lots and lots?
They are actually poised, potentially, I don't want to jinx it, they're actually going to surpass Apple as the biggest cash flow generator on a 12-month rolling basis.
And they have just been dishing it out into what we call the circular economy. They've been investing in all of the ecosystem to try and ensure that they can continue to build, that people want to be buying their chips in the neo-cloud space. It's interesting, that competition, though, that might be coming for them. Google's TPUs now being in a deal with Blackstone to roll out into a neo-cloud competitor. It's a lot going on in the space.
A lot going on in that space, and one guy who has his finger right on the pulse of it is Ted Smith, president and co-founder at Union Square Advisors. Excuse me, Ted. Great to have you here.
Thanks for having me back.
I do want to kind of talk about this sort of a funnel of cash, if you will. Obviously, a lot of it coming from NVIDIA itself, but obviously quite a few other names as well. And the sort of flywheel that's being built with regards to AI as an investable flywheel that is. Because I think if we had had this conversation a couple of years ago and you say what to buy in the public markets, it would have been NVIDIA and maybe two other companies. That's expanded, right?
Absolutely, it has. We're certainly seeing other companies who are enjoying being part of that flywheel over time, and I think we'll see more and more of it. The real question is, when are we going to get a handle on how much some of this is going to cost? So let's just take one example. Meta's Louisiana data center project, they started by telling the world it was going to cost $10 billion. Now it's up to $27 billion, and I've seen published reports that say it could go up to $200 billion. That all may be a perfectly wise investment on Meta's part, but until you can get a handle on where it's going to stop, it's hard to know what the returns are going to look like. Certainly, it's hard to know what the timing is going to look like.
Does it make sense, though, to continue pursuing those investments given the potential promise? Because we talk about the increased costs of memory, the increased costs of infrastructure and build out, and now you have interest rates, at least on the longer end of the Treasury curve, at the highest that we've seen in 19 years.
Right. The short answer is we believe it does, but we also think it's going to take longer to realize those returns in AI. As great as the promise of AI is, I still personally think we're a long way from artificial general intelligence. I think we've got a long way to go to get there. But the alternative is to not invest in it, to not pursue it, and end up being left far behind. And I think that's even scarier for most of these companies putting these billions of dollars to work.
So when you think about where is left in the ecosystem, there was, money's been put to work in the power demand and supply side of the equation. We've seen the hardware and the skyrocketing of global chip stocks, not just Micron that's doing well over here in the United States. But then there's potential for these companies to go public. Anthropic, OpenAI. How much are you even with AGI a little way off from your perspective, how much are they the companies you want to get into as they go public?
I think they're clearly the leaders in their respective spaces. The tension between OpenAI and Anthropic is super interesting from my perspective as they jockey for that position. Obviously, SpaceX is its own animal. Databricks would also have to be in that conversation for a likely or at least potential IPO this year. That's going to suck a lot of dry powder out of the investing capital, and it's going to come at the expense of medium and smaller sized IPOs. We're not going to see as many of those as we see these really big blockbuster IPOs.
What does, for example, a SpaceX going public, and we're waiting with bated breath as to whether we'll get some sort of public filing because many anticipate it will be done by the end of June. What does that mean for selling off of Tesla in the public market? What does it mean for people trying to clear the deck, make space in a portfolio they quite like, but having to decide which names they like less than SpaceX?
Right, and I think it's more than just Tesla. I mean, that's obviously a sort of an Elon trade, if you will, but there are clearly going to be pressure on other folks who are not viewed as attractive as SpaceX over long term. And you've got to get your head wrapped around a really big valuation to believe SpaceX is going to be attractive long term, even to buy in.
Do you think it is?
I think it will be when it ultimately comes out based on what they can do over the long haul, but you're making a long-term investment in what they can ultimately deliver on data centers and space and launch and everything that they're going to be part of. But the point I'm making is there will be downward pressure on other names as people clear the decks to try to have enough capital to make a dent in a SpaceX investment at the IPO.
I do want to ask you about AI disruption or the potential for disruption. We've seen a pretty prolonged sell-off in a lot of software stocks, although a bit of a rebound the last couple of days, and some interesting analyst commentary saying everyone needs to kind of cool it just a little bit. These companies aren't going under. But anyone who's used some of these AI tools, the advanced AI tools, you can see how it can replicate some of what these software companies are already offering.
Right. So I'm in the cool it. I think it's overblown camp for sure. I don't think the biggest software companies are going to go away. I think one of the two things that I think are most interesting that haven't been talked about as much are, one, we actually did something like this before with a different rate of change and with a different dynamic. But when we moved from the software license and maintenance model to the subscription model starting about 20 years ago, there was a huge amount of upheaval with software companies as they had to make that transition. Some made it and some didn't, but the people who grabbed on and figured out how to go through it, it was a turbulent ride, but they got to the other side and they did just fine. We're going to end up doing that again with AI. Some companies are going to embrace AI and a new pricing model associated with AI. It's not going to be just per seat subscriptions anymore. Those that do are also going to do fine. Those that don't, they're going to end up lagging.
I am curious about the issue of scale, though, and the idea that there seems to be this winner-take-all mentality that the people who manage to scale up first, the companies that manage to scale up first, are going to be the dominant players forever, or at least the more reasonable future. Is that a scenario that is palatable to you or believable to you?
It's not. I think there are multiple winners here, despite the winner-take-all mentality. Again, if you go back to that conversion to SaaS, there was a time when people didn't know what Salesforce.com was, and the market was dominated by companies in that space, by Microsoft and Oracle and Siebel Systems, and names that old guys like me still remember. Salesforce comes zooming along, and now they are obviously one of the dominating companies. There will be more companies that are going to emerge that we don't yet know. Will they supersede those same companies that I was talking about, at least Salesforce, Microsoft, Oracle? Time will tell, but it is not going to be winner take all in AI.
Salesforce down 32% year to date.
Wow.
Painful ride.
Painful ride. All right, Ted, we have to leave it there. Always great insights. Ted Smith, president, co-founder over at Union Square Advisors, helping us count you down to those closing bells, which are just about 2.5 minutes away. Stocks off the lows of the day, Caroline, but off the highs as well here. The S&P down about 0.7%, and we continue to see a persistent sell-off in some of the tech names, not just in the software space, but in the chip space as well. And maybe that's just, I don't know, maybe profit-taking, or is there something else going on?
Or is it the bond market that's shaking out the rest of the equity market right now? What is it, 30-year yields?
Yeah.
We spiked up to the highest in a couple of decades. We've got an inflationary pressure, and maybe it just makes you question some of those highfalutin purchases you made in recent weeks.
Flirting with 5.2% on the 30-year yield. A full breakdown of all of today's market action starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Caroline Hyde. Katie Greifeld is out on the day. We're taking you through to the closing bell with a global simulcast. We're joined right now by Tim Stenovic and, wow, Carol Masters off. Alex Semenova in for her today.
Surprise.
Welcome to our audiences across all of our Bloomberg platforms, television, radio, and our partnership with YouTube. So that means, Tim, with Carol out, you have to be my foil today.
I'm ready.
Yeah, right.
I'm ready. Stubbornly high is how I would describe oil remaining right now. If we look right now at Brent today, up to $111 a barrel, WTI up to $108 a barrel. That's a big part of the story, but Alex, I think a big part of the story today, yeah, it's equities, but more so, it's the bond market.
Yeah, it certainly is. Rising yields already adding to the pressure that oil prices have been posing to equities, especially after the run that we've had over the last several weeks. Of course, semiconductors on a tear, up 60% over 6 weeks. So investors are taking some profits as they see risks from oil and yields.
Look, and the key macro event, yes, it might be geopolitics. Yes, it might be oil. It's also going to be Nvidia after the bell tomorrow. And many people sort of waiting with bated breath as to what that means for some of the big bets we've seen in hardware, whether we've seen Micron shooting ever higher, where we've seen some of the domination, as you say, in the semiconductor space. But it's interesting that software has caught a bid in the last couple of days. Absolutely.
And, we started to see some of the analysts come out on the sell side here, basically saying that the sell-off that we saw in the software space, a bit overdone. There was an interesting, I guess, a resumption of coverage of ServiceNow now yesterday by Gil Loria at D.A. Davidson, making the case here, partly making the case that we just heard from Ted Smith, this idea here that these software names aren't going anywhere anytime soon here, and that the sell-off there might have been just a little bit overdone. We are getting the closing bells here in New York. You can't hear them, but trust me, they are happening. And unfortunately, we do have red across the screen with the Dow Jones Industrial Average finishing lower on the day by about 300 points, or about 0.6%. The S&P 500 is going to close lower for a third straight day, down about 0.7%. A 3-day slide for the NASDAQ as well, down about 0.8% on the composite, 0.6% on the 100, and the Russell 2000, Tim, down 28 points, or 1% on the day.
Inside the S&P 500, 185 stocks did move to the upside today. 317 moved lower.
I'm looking at the industry breakdown here. Healthcare on the upside. Energy, unsurprisingly, on the upside as we continue to see that pricing pressure on oil. We're seeing utilities catch a bit up a percentage point. But if you dig to the lower side, materials were off, communication services, we're seeing consumer discretionary as well. Interestingly, that the banks, the financials, sold off by 1.2% as well.
All right, well, I had one job today.
Okay.
And that's to do gainers and decliners.
You got more than one
rather.
job, Tim.
I hope you do it well.
Well, here's the problem. Here's the problem. I don't know if you guys can see that. The SOX has been all over the map today.
Yeah.
A lot of volatility. In fact, it started the day out lower, then shot higher. I was very confident just minutes ago that it would end in the green.
Yeah, and you missed that.
I missed it.
You're like Carol Massar today.
Yeah, that's okay. Yeah. That's the thing. Down 0.2%. Let's talk a little bit about Amer Sports. It's the parent company of Arc'teryx, Solomon Wilson, Armada Skis, and more. Amer Sports shares lost a little bit of the steam today, but still finished the day higher by 1.6%. The company actually came out and said consumers are prioritizing their health. They're looking for premium products and sustained demand, even in an unfavorable economic climate. So I guess we're still treating ourselves when it comes to buying these things. The company now expects revenue to grow to 20 to 22% this year, up from an earlier forecast of 16 to 18%. And finally, shares of Hyperliquid Strategies. This is sort of like a kind of a crypto shout out.
Wonderful.
PER is the ticker, 13.6% to the upside today. The SEC is said to ready plans for trading crypto versions of stocks. It's expected to release the so-called innovation exemption for tokenized stocks as soon as this week. It creates a new framework for betting on publicly traded companies. That's according to people familiar with the matter. Now, Hyperliquid Strategies is a digital asset treasury company, a DAT, but the firm also handles 24/7 perps. So it's sort of looked at as a way that you can trade 24/7 right now. So
real world assets, Tim, real world assets. Bob Diamond's the chair. I spoke to him last week.
Yeah. I mean, look, I think, and you just spoke to him actually this week, right? Was that this week or last week?
Last week. Time is an illusion, Tim.
Yeah, it really is. And I mean, I don't know, it seems like this idea of 24/7 or tokenization of stocks is like the next thing that all these companies are waiting on right now. It was what everybody talked about, FIA and Boca. And yeah, Bob Diamond, he's going all in on it.
And I'm going to start, guys, with Cisco Systems, one of the companies that was at the center of the unwind in tech that we got today. It fell as the company's CFO warned that Cisco would see, quote, ups and downs with its gross profit margin as it pushes, of course, into AI infrastructure. Shares are down 2.9% today. Cisco had impressed investors with its earnings earlier this month, but now that squeeze in gross margins is becoming worrisome. That is, of course, the percentage of revenue that they get after production costs are deducted. It has been a lingering concern for investors. And another company that I am looking at is Chewy. I would think that people's love for their pets is recession-proof, or at least that's what a lot of people said, but apparently not. Those shares are down to their lowest level since 2024, 9% on the day. This is also after comments from that JP Morgan tech conference today saying that basically the pet market has been resilient, but it's not immune to macro concerns. Its CEO talking about how they have seen a little bit of a more of a pullback from consumers this year.
All right, let's check in on yields real quickly here. Of course, the story of the day was what happened on the long end of the curve. Your 30-year yield flirting with 5.2%. That's the highest level that we've seen since the year 2007. But I also want to point out something that was also interesting today about the move higher in yields. Unlike the previous sessions, we actually saw oil prices fall today, only slightly there. But remember, normally the correlation was that the yields were going up along with oil prices. And that raises a lot of concerns about some of the structural issues going on in the Treasury market right now that aren't just about inflation, but they're about Treasury supply. And of course, are also about the somewhat lower volume and liquidity that we're seeing in this market that is also creating a lot of volatility.
Well, maybe we should just go to space.
Okay.
And build data centers?
It is the final frontier.
Well, so, we've been covering, and I know, Caroline, you've been covering this so closely on Bloomberg Tech, but the upcoming SpaceX IPO, it's getting a lot of attention, but what's not getting as much attention is just how well some of these other stocks in the space universe, for lack of a better term, are actually doing. Alex got this story on our radar a little earlier today. But SpaceX, not the only player, at least when it comes to soon-to-be public companies. Alex, a lot of interest with the already public companies, Planet Labs, for example, and some of the ETFs that follow the industry closely, too.
Yeah, I have to say, guys, I was at a hedge fund conference earlier this year, and everyone was talking about this idea of space being an asset class of its own. And just for some context right here, looking at some data from Deutsche Bank, the top 40 global space stocks market capitalization, it was $68 billion in April of 2025. It is now $250 billion. Really incredible.
I mean, Rocket Lab. It was interesting. The Rocket Lab stock dropped amid some of the Treasury yield pressure, some of the minute that what looms large is a macro policy concern. And once maybe we start to see a little bit more profit taking, it'll be interesting to see how much people, we were having a conversation earlier, clear the decks ahead of SpaceX actually coming. Are you going to sell some of those previous winners in space to be able to put your cash to work in a newly minted public company?
You guys are boring me. Can we talk about the disco ball going on at Spotify?
Sure.
Yeah.
Do you like it?
No.
Why not?
It's very confusing.
You're a disco kind of guy, Romain.
No, I'm not.
I love it. Like 20 years. What's the?
Of course you love it. Have you seen the shoes Caroline's wearing right now? They're sparkling silver, very disco-ish.
Romain, what was the #1 band that you listened to in those 20 years on Spotify?
Okay.
Come on, you haven't played the game?
No, I have not.
Alt J was mine, which surprised me. How about yours, Tim?
Wow.
No.
Tim's not going to divulge.
The answer is no. Yeah, try not to get too personal here.
It's going to be a kid's one. It's going to be.
Yeah, that's exactly. The algorithm, they need to figure it out like Netflix has done, where, you have different sign-ins, so then my algorithm isn't completely ruined by like...
you can do that now.
On Spotify?
Yes, you can.
Oh,
I don't have to listen to just
You have to get the family plan, and each person gets their own, so it doesn't sully up your algorithm.
Yeah, but the kids in my house will not be getting devices for many, many years.
Oh, wow, look at you.
We'll see how long we can hold out.
All right.
Tin can, guys.
Exactly, tin can. Thank you. If you can get one off the wait list, right, Caroline? Yeah, that's the real question.
I mean,
Romain
I have no secret sauce for that.
Okay, yeah. All right, still time to get it in for next year's holiday season. That is going to do it for our cross-platform coverage of The Closing Bell. Is it this year?
Yeah.
Oh, okay. There we go.
Not to correct you, Arnie.
Thank you.
Yeah.
There it is. The foil of Romain. The Closing Bell. We're going to see you same time, same place tomorrow.
And our coverage continues here on Bloomberg Television with a big IPO and a big earnings report. Big news expected from the tech space this week. We're going to catch up with Ross Gerber of Gerber Kawasaki in just a second. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. Some breaking news. Earnings out of the restaurant chain Cava. The company raising its annual sales outlook, saying diners flocking to its restaurants, and now it expects same-store sales to rise as much as 6.5%. That's about 1.5% higher than its previous forecast. The company also reported results for the most recent quarter. Those comp sales numbers also surpassed estimates here, seeming to indicate that there is a bit more resiliency here when it comes to the health of the consumer. We also got earnings just a little while ago from Red Robin, the burger chain. Those numbers also beating both on the top and bottom line. And that company now says that it sees full-year restaurant comp sales of about 0.5 to 1.5% here. Red Robin shares up about 19% in the after-hours trade. Cava shares right now up about 8% in the after-hours trade. But of course, all eyes right now are not what's happening so much now in the after-hours, but what's going to happen tomorrow in the after-hours. And that is our top story of the hour. It's the Philadelphia Semiconductor Index and the 130% rally in the past year. Its second best 12-month rolling return since 1999 to 2000. But borrowing costs, they are spiking, and investors are reducing leverage, and it's raising concerns about whether the insatiable appetite for AI-related companies to buy all the chips they can at any price they're offered may finally get a financial reality check. NVIDIA CEO Jensen Huang, as always, remains optimistic about the industry's growth, but the proof will be in the pudding 24 hours from now when his company reports results. Analysts expect revenue growth of more than 70%, profit growth of more than 80%. Breathtaking for a company of its size. And it's hard to understate the importance of this report. NVIDIA, it accounts for roughly 3/4 of the AI infrastructure market and generates more net income for investors than all but 3 other companies, Alphabet, Microsoft, and Apple. And if NVIDIA's growth continues apace, it will surpass all 3 by year's end. In fact, it will likely tomorrow vault to number 1 in another key metric, free cash flow. NVIDIA, which 4 years ago had annual free cash flow of less than $4 billion, has now likely surpassed $100 billion on a 12-month rolling basis. That would put it past Apple, which, of course, for years has been the dominant cash machine on Wall Street. Joining us right now for what he expects out of tomorrow's earnings report and, quite frankly, what he expects for the quarters beyond is Ross Gerber, the co-founder and CEO of Gerber Kawasaki Wealth and Investment Management. Ross, great to have you here on the program. Obviously, there's going to be a lot of parsing of these numbers tomorrow. I think to a certain extent, they don't necessarily matter in terms of the quarter itself. People really want to look at the overall trajectory of where this AI story is going, and that's where I want to start with you as to where you think it's going and whether NVIDIA will continue to lead it.
Well, certainly NVIDIA is in a great position to continue to lead it, just to start with that, as their chips and their overall, software, hardware, packaging is unlike any other option for scaling AI. But I think the real question is, and what investors are trying to figure out is, they're sort of like, when does this cycle end? I don't want to attribute a valuation to earnings that could end or go back down, and they maybe are worried that it's cyclical. But what I think that those investors are missing is that this is a fundamental shift in computing to a whole new generation of what technology will be able to achieve for humans in the next decade. And that build out is going to cost several $1 trillion. So this build out is going to take time, and NVIDIA will be an extremely profitable, well-positioned company during this build out, which I think will last the next at least 5 years.
Well, I am curious about the build out and the cost of it, because it seems like that cost keeps rising. We've already talked, I think, before when we've had you on the program, the cost of memory and some of the other inputs to build these data centers and the related investments, not to mention the power and energy costs. And today we were talking about this big rise that we're seeing in long-term Treasury yields, which, of course, raises the cost of capital for anybody looking to borrow.
That's all correct. And that's the biggest risk to this story is the actual reality of implementation, which involves like certain level of political and societal risk, as well as just capital risk. And there's all these things out there that make doing this difficult. And that's okay, because that's normal for something that's so revolutionary and needing such intensive investment. But what really matters is what's on the other side. Is there profits there? And that is, I think, what most investors maybe are underestimating, is what are the upsides for these companies, and we perceive them to be massive. So AI is now, it's not the future, it's happening now, and the demand for it far outstrips the supply and ability of AI, and we expect that to continue for the next 5 years.
I am curious, though, and I'm just going to throw something at you, and this is from Michael Burry in his latest Substack post, and he's always been a little skeptical about this AI boom. Right. But he talks about this idea of, he doesn't think that the consumer appetite for pain, that is, for AI, will be as high as some people think. He's also concerned, of course, about the cost of the corporate build-out of this as well. And he is drawing a lot of comparisons, as you would expect, to the dot-com bubble. I do want to get your thoughts on that.
Well, Michael Burry doesn't run a firm, and he doesn't actually run that much money. My personal accounts that we manage for my own personal clients is 3 times bigger than his fund. So, let's keep Michael Burry in perspective. But what he's missing is there's 2 levels. From the consumer perspective, there is a price like what they'll pay for Netflix and what they'll pay for Chat or Gemini, and maybe that's $20 or $30 or $40 a month. But that's not where the big money is. The big money is in corporate and enterprise. So my company right now is building on Claude, and we're building a whole new presentation and portfolio system through AI so that we can automate all the processes our advisors do. And we've been building on this now for several weeks, and it just gets better and better. And it's like super cool what we're building, and it's amazing that we can build it like with a person who doesn't even know how to program. Mm-hmm. And so, this is the beginning, and companies like mine will spend thousands of dollars a month, no problem, for AI. It's worth it. The efficiency gains that we're already getting from AI are amazing. So for us, I think it'll at least increase our productivity like by 2 to 3 times. And the way I see it right now, irrelevant of like the gains that we get from customer service, happiness, and things like that, but just on financial level, that every dollar we invest in AI will probably have a 10 times to 20 times return. So we'll just keep investing in it.
I mean, you've talked about this a lot, about the opportunities out there. I am curious about just the widening aperture of investing in this space. And let's just stay in the public markets for right now. I am curious that looking beyond the obvious names, the NVIDIAs and Alphabets and Microsofts of the world, are there names that you're looking at now that you think might be sort of that, own this for the next 10, 20 years? It'll be the next Amazon or the next, whatever.
Well, I think that's yet to be determined. I think there will be companies that are going to come out that will be the next Amazon or Google, but that has yet to be determined as people are now starting to really deploy solutions over AI. I think the big winners have already been determined with, what we're using, whether it be OpenAI, Gemini, or Claude. And so I think we have 3 big winners in AI. But I think the real winners behind this that we're investing in, and you can see it in the multiples of these stocks, are the people providing power, because you can't do anything without power in this world, whether it's drive an electric vehicle or turn on your heat pump in your house or running a data center. We're in this like massive suck of power and energy, and that I think is where enormous opportunities lay in companies that we've added to my fund, in my GK fund, like Bloom Energy, for example, a really innovative technology company that's providing power to data centers. Quanta Services, another top holding in my fund. It's really just power and infrastructure services, because the biggest risk to AI is actually being able to build it.
Yeah, absolutely. Well said there. I mean, heck, even Ford got a bid last week when people realized, hey, maybe they can be a power company too. Ross, always insightful. Appreciate your candor. Ross Gerber, co-founder, CEO of Gerber Kawasaki Wealth and Investment Management, talking about, of course, the public markets and the big AI race. When we come back, we're going to talk about the private markets, or maybe the soon-to-be public markets, and that big SpaceX IPO, which is getting ready for launch. We're going to catch up with Brett Winton, Chief Futurist over at ARK Invest. This is The Close on Bloomberg. Elon Musk set to launch one of the largest ever public offerings that could come as soon as this week with an S-1 filing for SpaceX, seeking to raise as much as $75 billion, which would value the company at around $2 trillion. Brett Winton joins us right now, Chief Futurist at ARK Investment Management, where he leads the firm's long-term forecasts on these disruptive technologies and innovation. Brett, I wanted to start with the valuation here, roughly $2 trillion or so, depending on whose number you want to use. But I was looking at one of the models that you have put out, the open source model for SpaceX, and you're looking at a $2.5 trillion valuation by the time we get, I think, to the end of this decade, 2030?
Yes, well, we were when we published that about a year ago, but I'll say that the AI compute opportunity increases the potential for the company, at least from a top-line perspective, by at least 10x. And I suspect that once their filing comes public, we'll be able to recalibrate that forecast to actually their ability to monetize the Starlink system. And at least public reporting has suggested that they're monetizing at a much higher rate than we had previously modeled. So I think you should look out for updates.
Well, that's what I'm curious about, kind of what Starlink is worth kind of on a standalone basis. I think the latest numbers, at least that have been reported, something like 9 million subscribers, around $15 to $18 billion in annual revenue last year.
Yeah, I think a way to think about it is they have on the order of 500 terabits per second in orbit, and they get to charge for that bandwidth. And so take your number between 10 to $15 billion in revenue and say, okay, that's what they get from 500 terabits per second. The rocket they're launching later this week can loft 60 terabits per second into orbit. So 10 of those launches can double their overall satellite constellation. So it doesn't cleanly translate into additional revenue, but that's a good proxy. 10 Starship launches roughly doubles the revenue potential of the company.
I am curious about this. I mean, I'm sure you've heard some of the jokes about these kind of data centers in space here, but give me the sort of the base case of why AI workloads effectively would actually work better in space rather than here on the Earth.
Yeah, I mean, building a data center is very expensive. You're talking on the order of $60 billion for a 1 gigawatt data center. And when you do it in space, once your cost to launch declines beyond a certain point, you can be cost competitive with data centers on the ground. And your costs, as you learn to manufacture the satellites and the rockets, should continue to decline. Whereas when you're operating on the ground, you have to find spots with good power. You have to feed in all the physical infrastructure. So it gets harder and harder to build those assets. So at a certain tipping point, we think around $300 per kilogram into orbit, data centers in space make economic sense, and they're going to get more competitive over time.
So, I mean, what does that mean for, I guess, the lowly terrestrial hyperscalers that are building out all of these things now? Are they going to be obsolete in a few years?
Well, I think that the world is net short compute to an extreme degree. We're all compute starved. I have my AI agent running on my laptop right now, and it's crying, saying, give me more GPUs, please. And so I think within the early 2030s timeframe, SpaceX's lofted constellations will be competitive with the aggregate amount of data centers being built on the ground. But from here to there, there's literally trillions of investment that have to happen to support the AI models that we all use and love.
Hey, real quickly, Brett, I am curious. I mean, there's been a lot of talk about SpaceX, but obviously there are a lot of other players in the space, pun intended. And I am curious if there's sort of an underappreciated name, either public or private, that you've been keeping an eye on.
Well, in the public space, Rocket Lab is a really interesting company offering launch services. And I think that there are plenty of, companies that can move things around in space effectively and efficiently, force projection in the military space. So I think the declining cost to launch, we're going from $10,000 per kilogram to now we think less than $1,000, and with the Starship less than $100, creates lots of business opportunity that just didn't exist 5 years ago.
Brett, great stuff as always. Brett Winton, Chief Futurist over at ARK Investment Management. And an update for our viewers, according to Bloomberg reporting, we are expected to get that S-1 filing sometime this week, with the roadshow expected to begin the first week of June, which would then set up potentially for pricing in the second week of June and trading the day or so after. All right, coming up next here on The Close, we're going to talk with media mogul Byron Allen. He's going to join us live in Studio 2 to discuss his plans for BuzzFeed, his pursuit of stars, and his pivotal role in shifting the entertainment landscape. That conversation coming up next, right here on The Close, right here on Bloomberg. Our next guest is a pivotal figure in the world of television, presiding over broadcast stations in 11 U.S. markets, 10 24-hour HD TV networks, 4 digital streaming platforms, a 2-hour block on CBS Network, and one of the largest broadcast TV advertising operations out there. Now, he's adding BuzzFeed, acquiring a 52% stake in the company with plans to step in as chairman and CEO. I'm pleased to say we are joined live in Studio 2 by Byron Allen, the founder, chairman, and CEO of Allen Media Group. Great to have you here.
It's good to see you. 25 years. 25 years you've been here. Congratulations on your excellent career here. It's amazing.
Thank you. Mike would thank you as well. He's sitting over there.
Thank you, Mike.
I do want to know, you've done a lot.
I also want to thank Mike. Mike, I want to thank everything you do in terms of the donations you've made, especially to financing the education of black med students. Believe me, it's noted, and I want to personally thank you. Thank you.
All right, Byron, appreciate that. And he has done a lot. I do want to talk about your business. And you've acquired a lot over the years, and now you're acquiring a majority stake in BuzzFeed.
Yes.
Why?
BuzzFeed is a phenomenal brand. It's magnificent.
Still?
It's been around for 20 years. Jonah Peretti has done a great job. Everybody knows BuzzFeed. And HuffPost.
HuffPost is part of that.
Oh, yeah, and Tasty. These are great brands.
But they were brands somewhat in decline in terms of readership.
Yeah, I mean, look, what happens is that, you lose, the algorithms change, don't let anybody come in between you and the customer. Those are my 3 business rules. Number 1, don't let anybody come in between you and the customer. Number 2, don't run out of money. And number 3, don't break rules 1 and 2. And I think, the whole algorithm changing over Facebook, that gave it a little bit of a dip, but that's going to be corrected. Now we have more direct to the consumer interfacing. So BuzzFeed is phenomenal. HuffPost is phenomenal, and so is Tasty. I mean, listen, you know me, a lot of guys like to buy businesses in the penthouse and take them down to the lobby. I like to buy them in the lobby and take them to the penthouse.
Well, you're kind of paying penthouse prices. I mean, this stock was trading for less than $1, and when the headline crossed the Bloomberg terminal a few days ago, you're paying $3 for this. Why?
Yeah, I bought 40 million shares.
Yeah.
At $3, and I took 52% of the company. And I got 20 million cash today and a 5-year note, $100 million promissory note, 5% interest, due and payable in 5 years. Let's just remember 5 years ago the stock was $40 a share. Let's remember that this company at one point had a $1.7 billion market cap. What I'm going to do with BuzzFeed with Jonah, and Jonah is.
So are you running this or Jonah?
We're running it together.
Okay.
I'm chairman and CEO, and he's going to stay on board. He's going to be president of AI. Okay.
President of AI.
BuzzFeed AI. BuzzFeed AI.
Is that just a buzzword, or is there substance behind it?
There is serious. Well, come on now.
Explain it to me.
Okay,
because everybody's throwing AI on everything these days. You know that.
Okay, Romaine AI. I'm not even talking to a human being right now. I'm talking to Romaine AI.
My value just skyrocketed.
You just went up a lot. Right. I mean, come on. I mean, you're talking about a guy who's really, in my opinion, he's a creative genius. Look at what he did. He's one of the first people. So just stop right there. You put a period on.
I wanted to work for him back in the day. He wouldn't hire me.
He wouldn't hire you. No. I know why, because you were doubting him. You can't doubt the man if you want to work for the man, but you got a great job. You did okay with Bloomberg.
I did.
So here's what I would tell you. It's real simple. He has built a foundation that we're going to simply build on. We're not going to change all of this and that. I just spoke to everybody who works there and everything. I'm not taking away tabs. We're building on what you already have. Now, what they don't have is they're not in the streaming business, free streaming business in a big way. Now,
when you say streaming, like live?
Streaming, video streaming.
Okay, video
streaming, right? I mean, we're going after YouTube.
Okay.
Get your mind around that. I'm going to say it again. We're going after YouTube.
So when you address employees today, the general sort of pitch was that a bigger push into streaming, bigger
free
embrace
streaming.
Of YouTube.
Free streaming.
Okay.
Yeah, we're going.
And how do you make money off that? Ads?
Yeah.
Okay.
Yes.
Yeah.
I mean, the biggest streamer on the planet is YouTube. Okay, and there's only YouTube. This is America. We have Coke and Pepsi. Why is it that we only have one free streamer? We're going to have We're going to have YouTube and we're going to have BuzzFeed. We're going to have both. By the way, if you really think about it, Romaine, most of the content, 99.9% of the content sitting at YouTube is non-exclusive.
Right.
So what I would say to the content creators, put it at YouTube, which you're going to do anyway, and also put it at BuzzFeed. Do you want one check or do you want two checks? Two checks, better than one.
Do you have the infrastructure all ready to do that? Or
yes, and we're building it out. And also, that's what he's going to do. That's the AI. The AI allows you to build that infrastructure out much faster, much more efficiently. So that's the substance behind the AI. Without AI, I would not be sitting next to you saying, we're going after YouTube. And also, let me explain.
Go ahead.
I invested a little over $150 million to build out a streaming app called Local Now.
Yeah, I remember that, yeah.
Local Now. So Local Now uses artificial intelligence and proprietary software to curate, aggregate, and stream super hyper-local news, weather, sports, and traffic. Geofence to your zip code. Yeah, it is magnificent. Here's the problem. No one knows about it. Now, here's the other thing. We've won Best Streamer twice. Let's pause.
Yeah.
Let's appreciate that moment. We've won Best Streamer twice. Okay, we beat Netflix, we beat Amazon, we beat Hulu, we beat Paramount Plus. We beat them all twice. No one knows about it. Now, I'm going to take that technology, I'm going to marry it. I'm going to marry it with BuzzFeed and HuffPost. Now they're in the streaming business. 30,000 movies, TV shows, and documentaries. Over 600 fast channels. 400 ABC, NBC, CBS affiliates providing their local news. Overnight, they're a major streamer. And this is the perfect intersection of free streaming, premium content, using AI for free. See, I had dinner one night with Reed Hastings, the founder of Netflix.
Right.
And I said, hey, Reed, what keeps you up at night? He said, YouTube. I said, YouTube? He said, yeah, Byron, if they start presenting and start delivering premium content for free, how do I get people to pay me XYZ per month? I said, got it. I'm going to curate and aggregate really terrific premium content and give the world what they want.
How do you?
Free content.
What's the cost of that content?
It's all. That's the great news. It's a rev share. I've already aggregated. Go to Local Now. If you go to Local Now, you can authenticate from your zip code, and I'm telling you the weather, and I'm giving you sports and traffic in your zip code, and I've aggregated billions and billions and billions of dollars of content on a rev share basis, just like YouTube.
Is the content going to be primarily entertainment? Is it going to be news?
Everything.
I mean, everything. So you want to be everything to everybody?
I didn't say that.
Okay.
But I'm going to be. So you said that, but I'm going to be.
Okay.
And so what you, remember what you said, does it have news? Remember I said I've already have at Local
You do,
Now, 400 ABC, NBC, CBS, and Fox affiliates delivering the local news, right?
Yeah.
So go there. We already have 30,000 movies, TV shows, and documentaries. Go to Local Now, check it out. But it's not the greatest name in the world. Local Now, blah, blah, blah. Who cares? Now I have one of the greatest names on the internet. I have BuzzFeed.
Okay.
I have HuffPost is great.
Well, HuffPost is
amazing.
I'm just asking there, is there almost more value in the HuffPost name and their subscriber base than BuzzFeed itself?
It's not either or. We're doing it all. HuffPost is going to have streaming. BuzzFeed's going to have streaming. Tasty's going to have streaming. It's free. You know the world's favorite word, Romaine?
Costly?
Free.
Okay.
Free. You didn't pass the test. I want to talk to the AI, Romaine.
Is this a big pivot for you too? I had to ask you though too. I mean, obviously the Weather Channel probably your crown jewel. At least it's the thing most people kind of know you for these days here. This sounds like a little bit of a pivot away from the cable and traditional TV model No, it's no pivot?
No, because the Weather Channel is a technology platform.
Okay.
It's a technology platform.
All right.
You know why I was able to get the Weather Channel at a 1.85 multiple?
No idea.
Everybody on Wall Street looked at it as a cable network, and I'm like, no, it's not a cable network. But thank God you got it wrong.
Yeah.
Because I own it. It's a technology platform. It uses proprietary software to deliver at all the cable head ends to deliver the weather in your zip code. Okay, it's hardwired into the Pentagon as a matter of national security. Okay, it is a technology platform. That's what the Weather Channel is. So I'm in when I bought the Weather Channel, say, well, you bought a cable network. Yeah, you can call it that, but I have a technology platform that allows me to do something no other cable platform can do.
Are you interested in buying or need to buy anything else to sort of build out this vision?
Well, I'm building the world's biggest media company, so I'm going to constantly be doing acquisitions.
Yeah.
And BuzzFeed, I love the fact that it's publicly traded.
Right.
I love that.
So is there something out there you're looking at now that you want to share with us?
Yeah, I'm looking to buy everything. I'm trying to buy your shoes. I'm looking to buy everything.
I can. You're going to pay more than $3 a share for that.
Yeah, well, I don't know if it's worth more than $3 a share. But at the end of the day, we are highly acquisitive, and we're looking to buy assets that can work together in symphony. I mean, look at this. Okay, so I've taken over CBS late night.
Yeah.
Okay.
When does that start? This week?
It starts Friday.
Yeah.
It starts Friday, May 22nd. That was the night that my hero, Johnny Carson, my hero and my mentor, he stepped down. Friday, May 22nd, 1992. I'm stepping up Friday, May 22nd, 2006, 34 years later. So I'm taking that time period at 11:35, Monday through Friday. This is the time period that Colbert occupies as we speak.
Yeah.
And I'll be in that time period Monday through Friday with Comics Unleashed with Byron Allen, my favorite comedian. That's 2 half hours back to back, right? And then right after that, a comedy game show that I created, Funny You Should Ask. For every question, there's a funny answer. Now, I am paying CBS for that time period. And what I said to CBS, because I've invested over $1 billion buying ABC, NBC, CBS, and Fox affiliates, right? And what I said to CBS, you're spending between those 2 hours over $150 million to produce those shows.
So the production cost for your show is significantly less.
Well, they don't care because they don't have to spend that $150 million. I said, stop spending that money.
But you have to make the economies of scale
I make the shows,
work.
but I'm already making the shows for syndication in my cable networks because I own a 24-hour cable network called Comedy.tv. And I said, you're putting all these resources into this late night time period, and you're throwing the audience into me, throwing them to me with my local affiliates, and I'm running 1-800-SPRAY-ON-HAIR and 1-800-ABS in 15 minutes. Stop wasting your money. Save your $150 a year. I'll pay you millions for the time period. I will put my shows on, and they're working very well. Comics Unleashed is already on at 12:30 following Colbert. It's working very well, very well. And I said, guys, I'll save you easily $150, $170 million, $180 million. They said, let's do it. So we started putting the show on at 12:35 after Colbert back in September. We're doing great. According to Nielsen, I'm winning in 43 of the 56 metered markets. That's not bad for a show that just started in September. And they're making money day one. So I sell the commercial time. So I control 14,000 30-second spots over the course of the year. You want to buy one for $100 grand? But here's what I'm doing. I'm going to promote BuzzFeed and HuffPost in that time period.
Well, speaking of commercials.
Yes, you have to take one?
We live on those as well.
Do you?
Byron, it's been
a
pleasure.
How much does a spot cost?
A lot. Byron Allen, the founder, chairman, and CEO of Allen Media Group.
I have so much more to talk about.
And we should point out,
sell you.
Mike Bloomberg, of course, is the founder and majority owner of this network, of the company that owns the network. They're calling. Good to see you too, Byron. And when we come back, we're going to flip the channel and talk about the business of film. The president of Atomic Monster, Michael Clear, coming up next here on Bloomberg. One thing we know for sure about the fast-evolving media landscape is that horror is having a moment. We saw it at this year's Oscars with Sinners, Frankenstein, of course, the Best Actress Award over at Weapons, all getting nods from the Academy. Horror films also known for raking in especially higher profits. Lucky for our next guest, who has overseen a number of hits, including the Conjuring franchise, Annabelle, and a few others. Joining us right now is Michael Clear, the president of Atomic Monster. Michael, great treat here to have you here on the program. I do kind of want to talk about the economics of scale when it comes to horror films. I mean, the whole idea seems to be that even though they may not make as much money on a revenue basis as some of those blockbuster action films, in terms of a profitability basis, they have proven to be much more resilient. And I am curious as to what you think explains that phenomenon.
Well, what we do in our feature films is actually try to curate an experience that audiences want to get out of the house and go to the theater for. And I think that we provide something really unique in the entertainment landscape because the experience of getting scared with a crowd in a dark theater is still a premium experience that you can't get anywhere else.
To your question about the lower costs, I think that's kind of a natural result of the types of stories that we tell. They tend to take place in a house, pretty mundane scenarios. They don't require grand world building, big special effects. They're actually pretty low cost stories by the nature of how they're built.
I am curious though too. I mean, obviously the whole art of making movies is still, to a certain extent, an art, both a business and an art. Just how you sort of address sort of the idea of making sure that something hits. I mean, I think about kind of the success of Megan, which I think at least took a lot of the public by surprise. Of course, Megan 2.0 underperformed, and I'm not sure whatever happened with the reboot that you were supposed to have earlier this year, whether that's actually going to come out or not. Soulmates here, but what's the thought process and the business decisions that you make in order to sort of get these things out?
It's actually really simple. I like to say, keep it scary, stupid, right? We're actually trying to make scary movies. And I think when we deviate from that path, I think it has less of an impact on culture. When we can really hit the scary button, we like to say, when we test movies and there's a sense of contagion in the crowd, those are the times when we know we can really create a hit. Now, part of that process, obviously, at the kind of collision point of art and commerce, our job is really to identify talented filmmakers who have a very clear vision, try to protect that vision, but also the entire apparatus of creating a worldwide hit involves hundreds of people. Yeah. And I think one of the things that we specialize in is figuring out how to get everyone rowing in the same direction.
Well, I'm curious, can you talk about Kane Parsons, a director that a lot of people are talking about today? Backrooms, which I haven't actually seen, but it seems like this is all the buzz. Where did he come from? And give me kind of the origin story and where you plan to go with this and the partnership with A24.
Yeah, absolutely. Kane is definitely a special talent. It's kind of a unique situation because we had seen his short films when he was 15 years old. I can still remember actually getting on a Zoom with his dad, which is something I haven't really done with any other filmmaker in my career. And so we had identified his short films on YouTube, and then we expressed an interest in trying to develop them into feature films. And then it took a little while to kind of gestate the perfect story that I think respected his core audience, but then was also positioned in a way that it could expand on that audience. Obviously with the case of YouTube, it's similar where we have to really, give the audience a reason to go to the theater and not just watch the content on YouTube. So for us, the key was really leaning into, the scares at the core of his concept. And, to our benefit, I think Kane had such a clear sense of what his audience wanted that he was able to really be the kind of creative guardrails. And our job was just kind of to block the noise so he could do what he does best.
I am curious, though, too. I mean, you mentioned going to the theater, and I mean, I know you probably get tired of this question about the future of theatrical releases, and I am curious as to how you balance whatever demand is still there for people to go physically to the theater versus those people who do just want to sit at home on their couch and watch it on the streaming services.
Yeah, I mean, the competition for eyeballs and attention has never been greater, but I think our competitive advantage is that we really know the type of experience that we're trying to deliver to audiences. If you can really be laser focused on why they would, what makes the experience of going to the theater different from what they get on their couch watching Netflix, I think that you can be really focused on creating the conditions for them to really enjoy and feel like they've gotten their money's worth in a theater experience.
So the other issue kind of that's been facing Hollywood right now is the advent of AI tools. And I specifically use the word tools because we've seen a lot of filmmakers already employ some of these tools. But of course, there's still this potential threat, or at least perception of a threat, that it could upend certain jobs, whether it's on the production side and even to a certain extent on the acting side.
Yeah, everything we do is artist-driven. So, our focus is to understand all the tools available to the filmmakers that we work with and to let them really drive the process. Obviously, there's a lot of conversations right now about how AI can reduce cost. At the moment, we're really focused on,
whichever director we're working with, we want their experience to be what they want it to be. Some directors embrace it more than others, and we really try to curate the process to our specific filmmakers.
I do have to ask you just about a couple of the movies that you have coming up. I am curious about this Mortal Kombat movie, not a horror movie, but basically a franchise. And I am curious as to, A, is that still on track for the release? And more importantly, why Mortal Kombat?
Oh man, everything at our company is driven first and foremost by fanship. If we're not excited and passionate about the movies that we're making, then why do it? So my partner in Atomic Monster, James Wan, who is known for creating franchises like Saw and Insidious and Conjuring, he and I both bonded over being fans of the games, and we got involved in that franchise at New Line several years ago, and it's really a movie series that is driven by the fan base. If we don't have them on board, then we have nothing. So we've tried to be really loyal to them and to their expectations, and provide a movie experience that is a real roller coaster ride.
All right, well, I know a lot of people are looking forward to that. Michael, we have to leave it there. Real treat to have you. Michael Clear, the president of the film company Atomic Monster. This is Bloomberg. Let's set you up for what to watch over the next 24 hours, what could move the market. That includes some key earnings before the market opens, out of Target, out of Lowe's, out of TJX, out of VF Corp. Keep an eye on all of those names, but of course, also keep an eye on the granddaddy. That's going to come after the bell. We're going to hear from the world's largest company and probably the most consequential company in the last 20 years, and that is NVIDIA. The expectations are high. We're talking about 70+% revenue growth, 80+% growth on an EBITDA basis here, a company and a name that could move the market. We're also going to get an update on weekly mortgage applications and the Fed minutes from the last meeting. We'll cover all that right here on The Close, right here on Bloomberg.